Hey guys, what is going on? Welcome back to my Robinhood portfolio. As always, I hope you guys had a very productive day trading today. Another strong day with the markets, all three major indices in the green. S&P 500 up 0.36%, Nasdaq up 0.49%, and the Dow 30 up almost 92 points, 0.46%. You can see from my portfolio in the green today, up $71.99, representing 0.23% of my overall portfolio, and that was essentially unchanged in after hours trading. You can see here a very choppy market, at least for my portfolio today. Started about baseline here, $2 down, at one point up almost $113, $114 before kind of coming back here into the negative, and then a nice little rebound here, $6 or so, pulled back, rebounded, pulled back, and then rebounded right before market closed. Like I said, ending up 0.23%, which was not as strong as the three major indices today. Like I said, 0.36, 0.49, and 0.46%. But nevertheless, in the green. As I scroll through my portfolio, you can see a lot of green throughout my portfolio. The only real sector that did kind of pull back today was the healthcare sector here. So my pharmaceutical stocks and healthcare company stocks pulled back, starting with ABBV up on top, AbbVie down to J&J, Johnson & Johnson. You can see those stocks all in the red. Portola, which had a very good day yesterday of almost 8% gain, pulled back a bit. I was almost going to do a day trade today. Actually, I had put a limit order in for $19.25. Unfortunately, you can see here, it only got down to $19.26. Actually put a limit order in for about $2,000. So it did not get that buy in place. And as you guys know, I'm not able to watch the markets throughout the day. So I put in some limit orders in the morning and kind of hopefully watch those orders be filled throughout the day. So was not able to capitalize on that. I probably would have bought at 1925, and I probably would have sold anything above 1960. So it probably would have been a nice little day trade today. Unfortunately, could not get in and out on that particular play. And as I scroll through the rest of my stocks here, you can see a lot of green throughout my portfolio. A few stocks did pull back here, but for the most part, a very strong day overall. What I wanted to do today is talk a little bit about taxes for dividends. So as you guys know, there's a couple. Well, first of all, let me just say, as you guys know, you need to pay tax on dividends. So as an example here, Ford Motor Company, it's been a very good stock. It's got a great dividend yield here in the middle. If I can pull that up here, 4.697%. You can see on December 1st, I got a dividend of $93.30. And to make math just a little bit more clear, let's just round that to $100. So I get a payment of $100 for a dividend, but unfortunately, I'm going to be taxed at one of two different rates. So I can be taxed at the ordinary dividend tax rate, or I can be taxed at a qualified dividend tax rate. And these are based on essentially your income tax bracket. So, for example, if you were in the income tax bracket of 10% and had to pay an ordinary dividend, you'd pay 10%. If you paid a qualified dividend rate, you'd pay 0%. 15% income tax rate, it would be 15% ordinary, 0% qualified. And then if you had higher income tax brackets of 25, 28, 33, or 35%, if you paid the ordinary dividend tax rate, you'd be paying essentially those same tax rates, 25, 28, 33, or 35% on your dividends. But if you had the qualified dividend tax rate, you'd be essentially paying 15% no matter which of those income brackets you fall into. So for the 25% income tax bracket rate, you would be paying 15%. So you'd essentially save 10% from going switching from an ordinary to a qualified dividend rate. If you were in the 35% tax bracket, you'd save 20% going from an ordinary dividend tax rate of 35% to 15%. So it's got a very good savings there. I mean, you can make. Actually, you'd be saving a lot of money by being able to qualify your dividends. So how do you qualify dividends? Well, there's a couple of different criteria that need to be met. The first criteria was, I think it's a stock. It has to be, or the dividend has to be paid from a stock after 1992, which really, or 2002, something like that, which really doesn't factor into our calculations at all. So I'm going to kind of skip over that one. The second is that it must be a dividend from an American company or a qualifying foreign company. Essentially, all the dividends on Robinhood here meet that criteria. And the last one is the one that really is going to be deciding whether your dividend is an ordinary or a qualified dividend. That is the holding period. So the definition of what qualifies for a qualified dividend is that investors must hold shares for more than 60 days during the 121-day period that starts 60 days before an ex-dividend date. So that's a lot of technical jargon there. So essentially, you need to hold the stock for 60 days, starting 60 days before the ex-dividend date. So as you guys know, I've been an advocate of the dividend capture strategy. So in order for that to work, you'd have to hold the stock for 60 days in that 121-day period. So you could buy that stock before the ex-dividend date and then hold it, through another 60 days, or you could buy it a couple months ahead of the ex-dividend date, no more than 60 days ahead of the ex-dividend date, then hold that through the ex-dividend date and sell after the ex-dividend date. So you can do that either of two ways, but essentially you'd have to hold that stock for a period of time so that the dividend is qualified. And as I said, it's got a very, very good tax savings on that if you do qualify for a qualified dividend. So this is especially important for those individuals that fall into the higher income tax ranges, paying, for example, here in Ford, rounding that up to 100. If I had to pay the ordinary dividend tax rate and I fell into, for example, the 35% tax bracket range, I'd be paying, $35 to $100 back. If I fell into that same tax range, the income tax range, but I had my dividend qualified, I'd only be paying $15. So I'd save, $20 or 20%. So that's a huge tax savings there. And that's the reason why a lot of folks do not do the dividend capture strategy, because it's basically open yourself up to a lot of tax implications at the end of the year. I hope that makes sense. A little bit complicated, but essentially it pays to employ the buy and hold strategy for dividend investors. It doesn't make a lot of sense to be buying and selling stocks on a very rapid rate, because you'll essentially be getting dividends that are considered ordinary dividends and would be taxed at a much higher tax rate. For the example I just gave, the 35% income tax rate, you're saving yourself 20% by simply getting your dividends qualified, holding it for that 60 days and the 121-day period. Getting in and out, doing the dividend capture strategy, I think it's a viable investment strategy, but you're going to be paying a lot higher dividend rate if you do that. All your dividends are essentially going to be ordinary dividends, and even if you're in the lower tax brackets, at 10 or 15% tax brackets, you can save yourself that 10 or 15% paying 0% unqualified dividends if you fall in those rates. And like I said, the higher tax rates as well, the 35% income tax bracket, you'd be saving yourself 20%. So right off the top, you're going to be having a very, very nice tax savings there, 20% or 10 or 15% if you're in the lower income tax brackets. So yeah, just kind of wanted to talk a little bit about dividends, how they are considered ordinary or qualified, and what the implications of those are at the end of the year when we need to file our taxes. So yeah, let me guys know what you guys are doing for your tax implications, your dividends. As you guys know, I've been doing the buy and hold strategy for a lot of my stocks, but I've also been getting in and out with some dividend capture and doing some swing and day trades, which again, I think there's a difference in the amount of tax you pay on those capital gains as well, whether they're short-term or long-term. I'll do another video about that in a little bit later video. But just wanted to talk a little bit about dividends, and then also what the tax implications are for dividends, whether they're ordinary dividends or qualified dividends. So yeah, with that, I'll kind of end the video here. As always, if you enjoy my videos, feel free to like, share, and subscribe if you're so inclined. If you have any good tips for me, let me know. If there's anything unclear in the video, let me know as well. I know I went through that pretty quickly. It gets, to be quite honest, pretty complicated when we start talking about taxes and ordinary and qualified dividends, and it gets even a little bit more complicated with the capital gain stuff, which I did not talk about today, but which I will talk about in another video. Long-term and short-term capital gains have kind of the same situation happening. Whether you hold them short or long, there's different tax implications for that. And as you probably have guessed, holding stock longer and getting long-term capital gains is a huge advantage, just like the qualified dividend by holding the dividends in a much longer time frame. But yeah, I won't kind of go into that minutiae right now. So again, hope you guys understand the tax implications between ordinary and qualified dividends, and I'll sort of end the video here, and we'll see you guys tomorrow.